All right, let's jump right in. Today, we are decoding one of the most powerful tools in any trader's toolkit, the candlestick chart. If you've ever glanced at a financial chart and just saw a confusing mess of red and green bars, you are in exactly the right place. We're about to make it all make sense.
So, let's kick things off with a big question. How do you actually read the market's mind? I mean, how do you know if it's feeling bullish, bearish, or just totally confused? Well, traders and investors need a way to see that sentiment, and that is precisely the problem that candlestick charts were designed to solve.
You know, there's a great way to think about this. The market speaks its own language, and that language is made up of candlesticks. Every single candle tells a miniature story, a story about the battle between buyers and sellers in a given moment. So learning to read them, it's like becoming fluent in the language of the market itself.
So to get fluent in this language, we have to start with the absolute basics. We've got to learn the alphabet. And in this case, that means understanding the anatomy of a single candlestick. Getting this down is the first and honestly the most important step.
Okay, at the most basic level, it really just comes down to two colors. Green is good news. It means the price went up during that period. The buyers, who we call the bulls, were in charge. Red, on the other hand, tells you the price went down. The sellers, or the bears, won that round. It's the fastest visual clue you can possibly get from a chart.
But what's really incredible is just how much information is crammed into this one simple shape. Every single candle gives you 4 critical pieces of data for its time frame: where the price opened, the absolute highest point it reached, the lowest point it touched, and finally, where the price closed. We call this OHLC: open, high, low, and close.
And when you look at a candle, you'll see 2 distinct parts. That thick, colored part, that's the body. It shows you the distance between the open and the close price. Then you have those thin little lines that stick out from the top or bottom. Those are the wicks, or sometimes called shadows, and they show you the full journey the price took, from its absolute high to its absolute low.
Okay, let's really lock this in, because this little piece of logic is the foundation for everything else. A candle is green for one simple reason: the price closed higher than where it opened. That's it. So its body starts at the bottom with the open and ends at the top with the close. A red candle? It's the complete opposite. It's red because the price closed lower than it opened. So for a red candle, the body starts at the top and ends at the bottom.
Right, so once you understand a single candle, you can start to read entire sentences and paragraphs. And that's where patterns come into play. We use that classic analogy, right? The bulls who thrust their horns up, pushing prices higher, and the bears who swipe their paws down, pushing prices lower. These patterns tell us the story of who's winning that fight.
Now, the first type of pattern we'll look at is a reversal. Think of this as a major plot twist in the market's story. Let's say the chart's been moving down, down, down. A reversal pattern is a big clue that the old trend is running out of steam and might be about to flip and head in the opposite direction. The second type is a continuation pattern. This isn't so much a plot twist as it is, well, a pause for dramatic effect. The market is chugging along in a trend, it takes a little breather, and this pattern suggests that after that short break, it's probably going to keep going on its original path.
Let's actually put this into practice. We're going to zoom in on reversal patterns first, because, let's be honest, that's where the most dramatic shifts happen. This is how you can spot a potential turning point in the whole narrative.
Okay, a classic bullish reversal pattern is called the hammer. It's got this short little body at the top and a really long lower wick. You'll find it after a price has been falling. So what's the story here? It shows that sellers tried to push the price way down, but then, bam, the buyers stormed back in and pushed it all the way back up. It's a huge sign of a potential bottom. And what's really interesting is that the color of the hammer itself, red or green, doesn't really matter that much.
Now for a full story told across 3 candles. This is the morning star. It's like a 3-act play. Act 1, a long red candle shows the bears are totally in control. Act 2, a tiny, indecisive candle appears, showing that the selling pressure is starting to weaken. And for the finale, Act 3, a big, strong green candle shows up, signaling the bulls have taken over. It's like the sun rising after a long night.
And of course, if you have a morning star, you have to have an evening star. It's the perfect opposite. Found at the top of an uptrend, you get a strong green candle followed by that little moment of hesitation, and then a strong red candle confirms the bears are wrestling back control. It's a big warning sign that the party might be over.
Now, not every pattern signals a massive U-turn. Sometimes the market just needs to catch its breath before it keeps on running. These are continuation patterns, and they often show up as candles that just scream indecision.
So you want to look for candles like a doji or a spinning top. They have these teeny tiny little bodies and usually have long wicks on both sides. What that's telling you is that during that period, the price went on a wild ride, but it ended up opening and closing at almost the exact same place. It's a perfect visual of a tug-of-war where nobody won.
Okay, I need you to lean in for this next part, because it is without a doubt the most important rule of them all. After you learn these patterns, it's so easy to think you've found some kind of magic formula, but you absolutely have to approach this with a healthy dose of caution.
So what's the big takeaway? Burn this quote into your memory. Candlestick patterns are all about probability, not certainty. They highlight moments where, based on history, there's a good chance the market might move a certain way. But, and this is a huge but, it is never ever a guarantee. Think of them as a powerful tool for your analysis, not a crystal ball.
So there you have it. We've covered the alphabet and some of the basic grammar of the market's language. Now you can look at a chart and see stories of struggle, of victory, and of hesitation, instead of just a bunch of random bars. So the real question is, the next time you pull up a chart, what story is the market going to tell you?
All right, let's jump right in. Today,